Investments in securities are subject to market risks. Read all related documents carefully before investing.
Hello and welcome to the Weekend Investing Daily Bytes. We are shooting this episode on 10th of May, just on the eve of the exit polls from the Karnataka local elections, and also the important US CPI number that is due tonight. So these two events, if I may call them, will have an impact on tomorrow's trading, which is also an expiry day. And the market was extremely muted ahead of these events. Uh, but I would think that the market has gone really strong into this midweek section, closing since mid-December, which is a good sign. I mean, we are almost at a 6-month high already, and we are only, I would think, uh, approximately a couple of percent away from an all-time high on the Nifty. So I hope you can see the screen now. Sorry for the disturbance. So essentially, the Nifty heat map is telling us a very flattish kind of a day where we had some gains on HDFC Life, IndusInd Bank, some gains on Power Grid, but largely you can see gray boxes on the screen. Slight gains in Maruti, Tata Motors, Mahindra, Reliance, ITC, levers, but pretty much no major loser or gainer on the day. So market, was waiting with deep breath uh, with the outcome of these events. I am facing some issues today. Let me just refresh my screen once and go back to the presentation. Okay. So sectoral overview again, real estate, public sector enterprise, auto stocks, energy stocks came back slightly, but PSU banks, after a couple of banks reported their numbers in the last 2 days, Bank of India, um, Indian Bank, and Canara Bank specifically, although the numbers were reasonably good, but maybe the market was having higher expectation, and hence PSU banks were further, uh, you know, sold off at minus 1.1%. Now for the week, they're down 4.4%. So PSU banks, metals, and slightly on IT were the sectors where some selling was there. But other than that, the most of the sectors were in the green. Mid cap index took a dive in the morning but came back and closed very near yesterday's close, which to me is a strong sign that this market is not wanting to go down. Small caps had a decent correction yesterday, and today almost more than half of it was covered back. So again, it will try and uh, fight against this resistance in the coming days. Once that is clear, then of course a big rally can happen on this. Nifty Bank also coming down to almost 42,800, so a 500-point fall, and then if entire recovery for the day, and closing just uh, you know maybe 2% below an all-time high. So market is very, very strong from that perspective, and many stocks. This is an example of one of the stocks which we have in several portfolios. We did have it in many more, but some of them gave up in this fall. But just see the kind of run up the Varun Beverages stock has had from 100 rupees, near IPO. It's gone up to 1600, and even post COVID, it was available near 200 rupees. And in the last 3 years, from 200, we have seen 1600. So essentially, sort of strengthens the fact that prices that are unbelievably going up can have some very strong stories behind them. So, maybe after COVID, when it fell from 400 to 200, next time it came back to 400, a lot of people would have sold off here. That we've reached the previous high, 52-week high, and so we'll sell off and just see the singular run we've had since then. So always believe the price is trying to tell you a story. Now I don't know if 1600 will go to 3200 or it will drop down to 1100, but nevertheless, if you stick to the thesis that rising prices are telling you a story, more often than not, you will have winners on your hand. Now, the topic of the day is IT stocks. So, NASDAQ and Indian IT both are the focus. Uh, this is a quote from Octavio Costa on Twitter. He says, revenue growth of FANG stocks have been on a steady decline, very close to approaching negative levels. So, if you see the growth in tech stocks, we have not seen this kind of deceleration of growth in the last 2 decades. So this is definitely a lot of concern for FANG stocks or tech stocks in general, and in turn IT stocks in India also. Although one could argue that a lot of services of Indian IT stocks do not go to the tech stocks or maybe Nasdaq listed stocks. Uh, Stocks are trading at high double digit multiples with little or no growth in revenues and declining profits, and have never fared well in the market, especially during economic downturns through the history. So, a large section of the market is convinced that we are going into a recession, especially in the US, and FANG stocks, which are predominantly growth stocks, have taken a beating and will not be able to recover for a long period of time, and that may hit India IT stocks also. That is the thesis that is playing out. So this is that chart where each bar is showing the revenue growth percentage on a yearly basis. So we had, and this is last 20 years. So, you know, uh, after this heady growth in 2005-6, revenue growth came down to 10-15%. Then it rose back to about 50% by 2011, and then it came back to about 20-25%, and then, gradually more down. And recent spike after COVID went to about 45%, and now it is down to, single digit multiple here. So 4-5% is the average median sales growth amongst all these top names: Google, Netflix, Apple, Amazon, Facebook, etc. So this is causing that concern that the growth has vanished from these growth stocks. And you know people are arguing that all this virtually free money that was available all these years was the reason for this, at least this pump up that happened here. And even after 2008, actually it has come in waves, but a large part of this prior growth is being attributed to nearly free money and the way it was used for growing these organizations. Layoffs in the US are also at a peak. So this is a chart of the last few years in terms of where the big layoffs are happening. So immediately after COVID, we had the transportation or hospitality related layoffs, so Airbnb, Uber, etc. And then over a period of time, while there were some layoffs in some companies, but it was not much in terms of number of companies involved or the number of layoffs. But suddenly, post January 2023, where probably the decisions for the entire year are taken in terms of how much bench they want to have and how much excess that they have, suddenly you find that a lot of big names did a lot of layoffs on that. So one school of thought could be that all these big names were sitting on a lot of extra manpower and they have trimmed it. So maybe that fluff is gone and they're more efficient here onwards. The other school of thought is that if these companies have had to lay off so many people, then it must be really hurting, and that will take some time to heal. This is another chart from layoffs.fyi, where you can see that the employees laid off hit a crescendo here somewhere near January 23, and it has since come off. Even the number of companies with layoffs have come off dramatically. So that is also likely a silver line, that the layoffs are not, seem to have peaked out here for now, unless we have another wave that comes around. And this is another infographic which tells you about where these layoffs are happening. So this is probably the most concerning, where the retail and consumer industries, along with transportation and healthcare, are the big ones where the layoffs are happening, and that is actually linked to you can say the core economy and people facing industries. So there is definitely pain in the economy, especially on the retail and the consumer front, and that is where these layoffs have happened. So it's sort of a mixed bag, sort of a trend from a data perspective. And if we see from a chart perspective now, and if we were to see the Nifty IT, one would certainly observe that Nifty IT, which was near 16,000 odd pre-COVID, and it went to near 11,000 post-COVID drop. From 11,000, we went in a straight shot to about 39,000. So almost 3.5 times and more was this gain. So coming off 25-30% from here is sort of a natural correction. So I would not read that this correction means that the tech bullishness is over. But since this fall, it has traded narrowly in this range of 26,000 to 31,000. So we are sort of consolidating in this range, and that growth that we were seeing earlier is being digested. So right now, it is sort of in no man's land, if you ask me, where this bottom is very, very crucial, where this should not give away. We did come and retest this bottom when the Infosys results were out, but this bottom should not give away. Once it does start to give away, then of course we will have a decent leg down. That is my guess. But if we hold this support here, I think we can consolidate here and again build up post that. So this is something that one can look out for in terms of what cues to look out for. Another very interesting chart that I have been tracking is this Nasdaq versus S&P 500 correlation. So this chart is essentially Nasdaq 100 divided by S&P 500 index, and you can see here that since about April or May 2022, uh, we have created this sort of inverse head and shoulders pattern on this. We bottomed out somewhere near 23, exactly in line with the most layoffs and the maximum number of companies doing layoffs. And from there, it has built back up and also now a right shoulder. So this is telling you that if this breaks out and the pattern goes to its logical target somewhere near 3.6, techs who are actually leading the rest of the market if this is happening. Otherwise, if it fails below, let's say 3.1, then it could waterfall back down to this, and that would mean that techs are following or are worse off than the S&P 500. So this is the relative sort of a chart, and if we see it on a longer time frame, this is about 15 years. So you will see that this ratio has maintained on this trend line, and we exactly took support on this trend line and have bounced from here. So tech weakness, tech real weakness would happen if we break this trend line, in my opinion, or if we just start to lose versus S&P at least. But right now that is not evident. We are just 10% below this ratio high. So tech weakness is not my preferred probable outcome right now, although a lot of folks are talking about recession and tech weakness and coming of AI that will disrupt the tech world. But I think the jury is still out there as to what happens. So it is a tricky juncture, but I think given what the charts are telling us, maybe the worst is behind us. And but we also need to see the revenues come back along with some growth for some long term sustainability. Buy or hold is a tricky answer. I think we are in sort of, at least in Indian IT context, we are in a neutral territory, and that range that I showed you should be used to gauge when the large cap IT stocks will gain. But there are many smaller cap IT stocks, mid cap and small cap IT stocks that are already hitting new highs. So that gives me hope that there is action happening in that industry, although maybe not across the industry. So it's a promising where to enter and have very strong proper exit plans, because if we do get a massive recession in the US, then of course IT stocks here will get hit extremely badly. So thank you so much for watching this episode. I hope you're enjoying whatever insights I was able to share with you here. Please do keep sending us your comments and your suggestions. Your critiques are also most welcome. Good critiques and good feedback helps us in growing as well as realigning ourselves with what is the demand from our viewers. And with that, I come to the end of this episode. Thank you so much. Bye.